Hello, 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 and welcome to this live stream with Bybit Learn. My name is Han, and today we're going to dive into some of the hottest narratives in crypto this year. Thank you so much for taking the time to join us here on this live stream. But tell you what, before we get into today's topic, I want to get to know you a little bit, all right? So I want to know how many Bybit live streams that you have attended before, including this one, all right? So just give me a number, drop it in the chat, just type it there, and this will give folks a bit of time before we join the live stream as well. I want to see if there's any double-digit people among us here today. So yeah, feel free to just drop it in chat, all right? Before we really get started. Are you guys doing all right? Yeah, I tell you what, let's get right into it again. All right, so for today's topic, as I'm sure you've seen already from the title slide, say it with me now, perpetual decentralized exchanges, right? Now say it fast 5 times. See if you can do that, okay? Or if you just want to keep it short, you can just call it Perp DEX, and that's the term we'll be using for the rest of this live stream, all right? So Perp DEXs, they are shaking up the crypto hierarchy. Now, if you're wondering, well, why on earth is a centralized exchange like Bybit talking about decentralized exchanges, DEXs? First, that's a great question. The answer, transparency. All right, look, we know in the crypto world, it's maturing. There are more choices today for you than ever before. And most importantly, we're all about you making informed decisions. All right, so for today's topic, Perp DEXs, what's driving their popularity, how do they stack up against the big boys, and ultimately, what does all this mean for you? To unpack all this, I'm joined now by Andrew Melville. He's the head of research at Block Shoals. Andrew, welcome to the program.
Hi, Han. Great to see you.
Man, I really got to give you a shout out because I know it's super early in the UK right now. So thank you so much for being here on the live stream. And likewise to all of you joining right now, thank you for your time as well. So let's kick things off with a really strong foundational 101 here, right? We are going to be talking about Perp DEXs eventually, but let's take a couple of steps back. What are the key differences between a centralized exchange? What makes them centralized versus the decentralized, the DEXs?
Yeah, great question. Decentralized exchanges, it's in the name, right? So biggest difference is where that's hosted and how it works. So centralized exchange is private code, usually not open source, run on private servers. Decentralized exchanges trying to do very much the same thing, trading the same products, offering hopefully the same experience to users, but doing that on-chain in a decentralized way. So often that means governed by smart contracts, for better or worse, open source code visible on the blockchain, that kind of thing.
Yeah, and I'm glad you pointed that out as well, right? Because while for the average retail user, they may not be aware of the tech behind centralized versus decentralized, right? But in terms of the control, right? For centralized, the so-called power is with a company or an entity, where else with decentralized, if the power is with the community, right? At least by the textbook definition, although we have seen criticisms and a blurring of the lines, really, right? So with that in mind, right, perhaps for our audience, they may not be so familiar with the decentralized space. So let's go in and, as you can see on this chart here, right, talk us through some of these pros and cons and, that the average retail user might need to be aware of.
Exactly. So these pros and cons, they all stem from exactly as you mentioned, who's in control. From the end user's perspective, that determines who you want to trust, essentially. So if I'm using a centralized exchange, I'm trusting the people that are running that centralized exchange to do that properly, to be regulated correctly, to control my funds. If I'm using a decentralized exchange, then I'm still trusting. I'm just trusting a slightly different entity. So for a decentralized exchange, that's often code, tech, the protocol, the blockchain on which it lives, as well as my own ability to manage my private keys, to control my own coins, to custody my own assets, right? So on the left and on the right, both of these things, the pros and the cons, they stem from that ultimate trust. Transparency, for example, this stems from the fact that this exchange lives on the blockchain. If it's truly decentralized, then you need validators who are creating blocks, who are taking transactions and validating them, putting them into blocks on the blockchain, they need to see those transactions. Downside to that, at least historically, has been exposure to something we call MEV, so maximum extractable value. So if I'm a validator, I necessarily need to see your transaction before I execute it. Well, in traditional finance, in usual markets, that's leaving you open to something called front running, where someone can get into an exchange before you, change the price by trading, and then benefit from your trade that comes after.
Yeah.
So yes, it's transparent. But yes, you are exposed to this slight risk. And it's the same across all of these other verticals. So yes, I trust the exchange to hold my assets, but if I'm trading on a decentralized exchange, then I am in charge of my own assets. It's self-custodial. There is less of a counterparty risk if the execution of trades is processed by smart contracts, by auditable code. However, is it reasonable to expect the average trader, the person who is just looking to take exposure to assets, to be educated enough to be doing that audit themselves? Yeah, essentially there's a trade-off between the two sides here. Finally, I want to touch on KYC requirements. Far easier to jump onto a decentralized exchange, connect a wallet, load it up with some stable coins from an exchange on-ramp, off-ramp, and then start trading, right? So I think in a couple of the exchanges, which we're going to talk about a little bit later today, that's really a benefit for a lot of traders, the real ease of access to start trading almost immediately, as well as the faster listing times of these exchanges. They can get tokens on really quick. However, again, this comes with a trade-off. If I'm a trader and something goes wrong on this exchange, perhaps there's an error in the code, which we've seen happen many times before in crypto, then there's very little recourse for traders to hold someone accountable. So I'm trading off that trust in a centralized entity for the accountability that comes with a centralized entity as well.
Yeah, and look, to be clear, right, there is clearly a wide spectrum that we're talking about here. Everything from regulated, centralized exchanges that have added protections from regulators, that have, customer support, hand-holding, right, all the way to truly you trust yourself, you have to trust this code, right? And you're right to point out, so even though we are showing this really tidy table that we have here on the screen, but there are ways that you can slice and dice it, whereby it's almost like a double-edged sword for every single one of those points that you mentioned, right? So, and this is what we're trying to bring to the table here today, guys. Look, we're here at Bybit Learn, right? We're all about, like I said at the start, making informed decisions. So while, most folks are maybe not aware of the tech and may not be bothered about learning about it, but ultimately there is this fundamental issue that has to be addressed, right? Which is ultimately, do you trust the tech or versus these a whole other ecosystem with a whole different set of rules, right? So I think it's important for all of us to be at least aware of these, like Andrew said, the trade-offs, right? That you got to be wary of. So I'm glad you touched about the trust factor. But there's also something to be said about the access, right? I think you mentioned, okay, with the KYC, but also beyond that, I think, is it safe to say that at least for the DeFi world, it does require a bit more nuance or at least a substantial bit more tech knowledge to actually be able to access that really exciting world?
Partially, yeah. At least the entrance to the on-chain world, you still need to be familiar with wallets, with an on-ramp. In most of these cases, you can't trade with a credit card, you can't trade with a bank account. You need either stable coins or crypto assets. For many people, the on-ramp to those is still a centralized exchange. That's probably the easiest place for me to convert my fiat currency, for me pounds, for others dollars, to crypto, and then start trading in that world. But this also touches on the other distinction we should make, right, which is the perpetual decentralized exchange. It's not spot. These are derivative contracts. There is an extra layer of understanding when you are trading derivatives. In traditional finance, we are used to futures contracts, to options, maybe more exotic stuff. Perpetuals are a very crypto native thing. They existed on centralized exchanges for a long time now. probably the most popular asset or instrument class, I would say, on centralized exchanges. Is where we see a lot of that volume. But there's a distinction to be made there versus trading the underlying, right? And it's also what differentiates Perp DEXs, not just from Perp centralized exchanges, but from spot DEXs, which have existed for a lot longer, right? Even people who are familiar with trading on chain may have been more familiar with in previous cycles. So as examples, spot DEXs include Uniswap, this kind of thing.
Yeah. And look, oh, sorry, go on.
So really, it requires a little bit of education. It requires a little bit of understanding, but we are finding many people do see it to be worth it.
Yeah, education, understanding. That's exactly what we are about here. And you also mentioned a key phrase for the next segment, right? Which is Perp DEXs, which is what this live stream mainly focuses on. But before we get into that, look, we know beyond the learning, you guys are also here for the quick giveaway, right? Well, look, I think it must be said here that, at least in my opinion, learning is its own reward, but over here at Bybit Learn, we understand, so we want to make it that much sweeter. All right, so to do that, make sure you scan the QR code that we're going to pull up on the screen right now, and you can get your chance at your share of 4,000 USDT. At least in my book, hey, you learn more, you earn more. All right, so scan the QR code. Make sure you don't miss out beyond the head knowledge that you can get, and perhaps some, fatter wallets as well, right? Potentially, right? So first things first, make sure you scan that QR code, and we'll be populating or popping it up on the screen here every so often on the live stream as well. All right. So let's get right into the heart of the matter. All right. So again, to recap, we've got this spectrum. You've got all the way, perhaps on one side, regulated, centralized exchanges, all the way to complete and utter DeFi. But then there are nuances within the middle, right? So let's dive down into the Perp DEXs that Andrew mentioned earlier, right? So really, is this a product distinction that we've spoken about, the trust distinction, we've spoken about the excess distinction? Is this more of a product-centric approach here that we're talking about? Hence the adjective perp to Perp DEXs. Oh, Andrew, I believe you're on mute here, buddy.
Hey, sorry.
There
yeah, it's really a new generation of Perp DEXs that are making this difference, right? When we are looking at who's really outperforming in this space, it's not the legacy Perp DEXs that, names that we're familiar with. So DYDX, GMX, if you look at the numbers, if you look at the volumes that are being attracted to these exchanges, yes, we're seeing a massive increase in the number of trades that are going through perpetual decentralized exchanges, consistently $20 billion per day in the last couple of months in 2025. It's really not the legacy performers there. Instead, it is what I'm calling this new generation, which is types of exchanges like Hyperliquid or Aster. These are a new generation. Why? What's different about them? I think that the biggest difference is that these are often dedicated app chains that are built for this kind of trading, that are built from the ground up almost to facilitate the kind of problems that have, I would say, prevented on-chain trading from really exploding in the past. So that I've always referred to it as the on-chain order book problem. If you think about things like Uniswap, again, that spot decentralized exchange, what are the differences between perps and spots? Well, the biggest difference is that with perps, it's far easier for me to take leverage, right? I can trade on margin, I can trade with just a small amount of capital and get exposure to far larger price swings, up and down, right? So we're not talking convexity, we're talking leverage. So this is at least one differentiator to the previous generation. So things like spot DEXs, which work like usually with automated market makers, very different to the order book experience that traders are used to now from centralized exchanges, where I have a list of bids and a list of asks, and the top on both sides get matched. These dedicated app chains make that problem go away almost, right? It is far cheaper now to host that big list of orders on both sides on chain and have that match in a decentralized way, and then live on chain afterwards. So what is actually making that difference? What makes it, firstly, why is it tough to do that on something like Ethereum? Well, every time I want to submit a transaction to a network, I need to pay a small gas fee. Now, if I'm a market maker and I'm submitting many, many orders, I'm populating an order book across multiple different tokens, then this can get very expensive. If every time I need to update an order, I need to submit a new transaction, I'm paying a fee every time. This makes it very unreasonable and very hard to have a system like an order book live on chain. Computation on chain is just expensive. People like Hyperliquid, I would also mention DeepBook of Sui as well, which is an emerging tech, like a liquidity layer doing a very similar thing. These are taking advantages of low-level benefits on their own blockchains that make transactions cheaper and faster. These are chains with far faster throughputs, far more transactions per second, and they're able to process those at a far lower fee. This means that the familiar, the very nice user experience of an order book system can now be brought on chain. And I think we're seeing a lot of traders really take benefit of that. So really bringing that sort of CEX feel to the decentralized exchange on chain as well.
Yeah, cool. And look, I think going off all those virtues that you highlighted there, right? Let me just share this story real quick. So earlier this month, I was at Token 2049 in Singapore. Were you there, Andrew?
I wasn't, no. I wish I was.
And I'll tell you what, I wish I had known about this live stream before I attended, so I would have taken a lot more, a lot more detailed notes, because one name kept popping up a lot, and that was Hyperliquid, right? So, I think going back to what you were saying, I think we can best show it if we pull up these charts that we have here, right? So again, just talking about the popularity, not just on the lips of those in attendance at crypto conferences, and certainly those online, that they have a very engaged community, but just look at the raw numbers here, right? These are the open interests on specifically on Bitcoin perp swaps, right? And then, like you said earlier, right, if you look at this list, it's mainly some of the big boys and the more familiar names that you've known that have been very active and outsized in this crypto world already for a long time, right? And of course, Binance, Bybit, Deribit, OKEX. But then there you have it. Hyperliquid is just a couple of years old, and that's already talk about them running I think revenues and cash reflows of about $1 billion a year, right? So they are seeing this tremendous growth and really shaking up the crypto hierarchy, isn't it? And then if we go to this next chart as well, if we look at see how their tokens have performed in relation to the tokens of other DEXs. If we can move on to the next slide here, right? And we can see that outperformance playing out as well, right? Yeah, right there. Talk us through, because this is your chart. I don't want to steal your thunder here, buddy. So Andrew, talk us through what we're seeing here.
Yeah, absolutely. This is really a stark chart, right? Really a game of two halves almost. If you look at the first part, then what we're showing here is essentially performance in 2025 relative to where it was at the start of the year. So we're already post-election, we're already post-Trump's win at the polls. So New Year's Day, everything's selling off, everything's moving lower. We really start to bottom out around April, Trump's Liberation Day tariffs. And then the second half of this chart is really where the story explodes, right? So first thing that jumps out immediately is Hyperliquid in blue, really strong performance in its token here. So this isn't trade volumes, this is the token asset price. Really strong performance in 2025, but also strong performance relative to a lot of the other exchange tokens. So here we're showing Uniswap, which is that spot decentralized exchange I mentioned. There's Jupiter, which is again a DEX on Solana, and then GMX, one of the legacy perpetual exchange DEXs. So if you're thinking about this narrative of PerpDEX is really outperforming, again, this is this is really not a really broad brush we can paint with here. This is really in a couple of names who are really stealing the show in terms of performance. So what is it that's leading to Hype's outperformance in spot in terms of its token value? Well, Hyperliquid are doing something slightly different, or at least it was different when they began to do it. We're starting to see a few other people copy that now. But firstly, Hype is outperforming because it's accumulating a lot of fees, right? People are using the exchange. People are trading on the exchange. They're paying fees. And they're doing that for a variety of reasons, the UX benefits that we've mentioned so far. But the real difference is that a large proportion, I think something like 97% of Hyperliquid's fees are used to buy back the token, buy back and burn that token, removing it from supply or acting as a source of demand, depending on how you want to look at it. Yeah. So what does that do? It really makes a clear link between the performance of the exchange as a business, as a fee generating operation, to the value of the token. Now, that sounds obvious. Anyone coming to us from equities markets will think, okay, well, it's like a dividend or it's like a share buyback. And it really is. But that's not something that has been quite as taken for granted, let's say, in crypto. Not all tokens are used to buy back not all fees from exchanges are used to buy back tokens. Not all tokens have that clear link with their protocol. In many cases, we're looking at tokens that are used for governance, for setting fee parameters, not collecting fees. So here we have a far clearer link, and we're seeing a lot of other Perp DEXs start to do the same sort of thing, maybe not in the same sort of proportion. 97% is quite a lot. But I think that's what really drives that flywheel effect almost, where you have a token that is tied to the fundamentals of the underlying protocol now.
And look, that 97%, right? And that's certainly a gobsmacking number as well. But I believe also in some of our analysis, right? I think here's something that's really important for our viewers here to be aware of, that there could be a potential drop off in the near future as well, eh? Like perhaps about a month from now, right? Talk us through that.
That's a great question. When you look at a price chart like that, the question is, how sustainable is a rally like that? Yeah. I mean, we're seeing the same in gold, which has nothing to do with any buybacks or it doesn't even have a yield. So completely natural question. And yeah, there's no guarantee that any of this continues. In Hyperliquid in particular, then there is a question of the supply that gets dropped into the asset class, right? So in crypto, we're very familiar with token drops, with airdrops. This is how Hyperliquid was introduced to the market in, I think, late 24. But yeah, we're starting to look at some of those locked up tokens now be unlocked into the future. Question is, how does the pace of buybacks continue in the future? And how does that compare to the airdrops or the unlocked tokens that are coming to the market as well? So really a balance of supply and demand. The question is, we know what the supply is, we know what that dropped tokens are going to be. The question is, how much will Hyperliquid continue to buy back? And that's really fee dependent, right? So what do I mean fee dependent? People need to keep trading on Hyperliquid, keep generating, keep paying fees to the exchange in order to keep that buyback funded and therefore continuing into the future.
Yeah, I appreciate that GCSE or IGCSE for the rest of us in the outside the UK, right? That GCSE level Econs 101 lesson there, right? It's good old supply and demand, right? So assuming that you've got this incoming supply towards the end of the year, will demand be robust enough still to absorb that supply? Otherwise, there's going to be this potential mismatch in prices, right? So, but for now, at least based on the charts that we have shown you, right, there has been this clear outperformance as well. Now we've got some great questions from already coming in from you guys, and some of the things that we've already spoken about, right? So again, some of the risks that we mentioned earlier in the discussion, right? How is the UX different, right? So for example, Andrew mentioned earlier the KYC processes, right? And also about the security, which is we've got a couple of questions about the security, and let me read this one verbatim. Quote, how do perpetual DEXs handle high volatility events compared to centralized exchanges? End quote, which is a perfect segue into the final part of our chat here. But before we do that, again, a quick reminder about your share of 4,000 USDT in rewards. Again, we can pull out the QR code here to our super producer, Galvin there, right? So again, you got to scan this QR code now and get your chance at a share of 4,000 USDT. All right. While also we're doing that, I just want to show people, just to kind of tie a ribbon around what we've just discussed earlier about Hyperliquids and DEXs outperformance, right? Or sorry, Hyperliquids outperformance. I can just show you the really beautiful article that Blog Scrolls has written and that they've done and published on our website. Let's pull up my screen here, Galvin, right? And I can show folks where you are. So you head on down to bybit.com, right? Head on over to the Learn tab. You're probably on the live stream tab right now, but you can click on Bybit Learn, right? Once you get there, look for the blog button, right up there on the top. Click on Crypto Insights, and you will find lots of juicy insights, not just from the crypto world, but from other asset classes as well. And again, this one that we are talking about in particular was written a couple of weeks ago, right? But we are doing this live stream now. So hey, if you want to get into more of the meat of what we're talking about, feel free to check out that article. All right. So which brings us back to the very astute question from one of our viewers here. Look, how did these Perp DEXs really weather 1010, right? Obviously, you wrote that article after October 10th, is what's described as the largest crypto liquidation event in history, right? And then we are also now having this chat, a couple of weeks further out, right? So, I think it's perhaps telling if we can show some charts here about how that story manifested itself through the token performances, right? So let's, I'm going to share my screen again. So we've got a few screens that we can show you. All right, first, let's start with this. Right, so again, you've got Bitcoin, ETH, right? The two big ones, and then you've got Mental. Now, Mental is the native token for the Mental network, or I should say, MNT is the native token for the Mental network. And here on Bybit, it can be used as a pass as well, that you can unlock rewards, use for trading, earn, etc. Right, but then you look at Hype as well. But overall, I think since that long tail on the candlestick there from October 10th, rather I should say. You do see cryptos actually trying to find this more stable footing, right? So I think there is something to be said there in terms of the price action. There is this overall maturing that, hey, despite that historic event on October 10th, we are coming out on the other side of it, right? Let's go back to the slides. Also, we've got another chart there that shows, I think, yeah, this one then shows it in a different format, right? This is in percentage terms, right? So the green one, Mental, and then you just make your way down the line, MNT, I should say, right? So again, there is this maturing, or at least this resilience, at least for now, in terms of the price action. But I think also operationally, right? There is a lot more transparency about how exchanges like Bybit has actually weathered the storm, right? So I think we can move on to the next slide. And now, Andrew, I'm going to throw this to you, right? Because as our good people here are making their way through this slide, all these talking points, how important is it that viewers and just crypto bugs, they just need to be aware of these things? And it goes back to some of the questions that you guys have posed, right, about the security and the risks, whether it's a battle tested platform, right? I think that's absolutely key, isn't it, Andrew?
Yeah, that's the key word, right? Battle tested. But to your question, to your point, more important than ever that crypto firms get their house in order, not just centralized exchanges, not just decentralized exchanges, but all firms. I mean, we at Block Shoals, we're research, data analytics, ancillary services for trading, that kind of thing. And even we see the demand from the key point here is institutions, right? That's what's different about this cycle. So more important than ever that crypto firms get their house in order and take that opportunity with both hands. Institutions expect a certain level of professionalism, right? In trading frequency, in uptimes, in stability, in robustness of infrastructure, availability of data, quality of data. This is something we see a lot as well, something we put a big importance on. But also recourse when things go wrong. People are used to, when we're talking about centralized exchanges, yes, these exist in crypto, but in TradFi, they're just called exchanges, right? There's no distinction to be made. If you think about NASDAQ, New York Stock Exchange, London Stock Exchange, ICE, CME, all of these things have established practices, are well regulated, well controlled. And that's what's really allowed the financial system to grow, is the confidence that all of this stuff will work as expected, right? All of that in the legacy system has been battle tested. The main question that I think a lot of institutions will look at for decentralized exchanges is, can I trust this? Do I know it's going to work? Do I have the confidence that if I am trading in the multiple hundreds of millions, that it's going to work as expected? If I make a trade and I get it right, am I going to get paid what I expect to make, right? So some cases, those same institutions will look at decentralized exchanges and think, yes, this tech comes with quite a lot of benefits. Now, we're already seeing the first signs of that in payment rails, so cross-border transactions, as well as stable coins, right? Institutions are looking at this and thinking, well, hang on, this settlement time is far shorter. My fees are far lower to send cash, let's say, overseas or between borders. As long as I trust the technology is going to work and this is truly decentralized, can't be taken over by foreign governments, then yeah, I love this. I think this is a great thing for my business. The question is whether that then applies to things like trading, decentralized exchanges. And I think in some cases it will. One of the big benefits that we mentioned at the beginning of the show was that decentralized exchanges come with a big pro, and that's far lower counterparty risk. I know that in most cases, if let's say I'm trading on a decentralized exchange with derivatives, then up until now, the most popular implementation of that has been fully collateralized. So I know that my counterparty has put their ETH, their stable coins, into the smart contract, and that smart contract will decide if I'm correct in my trade, then I get paid. The cash is already there. Whereas in TradFi, there is at least a little bit of a credit risk to deal with and to price in as well. New Perp DEXs now allow you to trade on margin, which again, how do I know that I'm going to get paid if I'm correct in my trade? How do I know that my counterparty, the person I'm trading against, is able to front the losses that they make? They have liquidation engines, and those liquidation engines are powered by oracles. They process the payment of a trade, or the settlement of a trade, according to certain rules, which I can read in a smart contract. So as long as that code is auditable, by which I mean I can read it, I have confidence that it will work as expected, then great. This is a benefit to me and I can use it. However, again, I come back to the other side of that table we showed. The con there is that if that smart contract doesn't work, if that smart contract works as expected, great. But if it doesn't and it causes a loss to me, then I don't really have someone that I can hold accountable to that, right? Which is something that institutions from traditional finance have become very used to. So to your point, to your question, how important is this for crypto traders and investors? It's important now. It's always been important, but it's only going to get more important in the future.
Yeah. And look, we've got already some really fascinating questions and comments from our viewers here. Thank you guys so much for those. Keep them coming in, right? So I think the first one here is asking about more educational resources. Well, guess what? Already we have got published on our website. So again, I'll show you guys how to get to it. Galvin, super producer. If you can go back to my screen again, I'll just show people how to get there. So again, head on down to bybit.com. Just click on the Learn tab. right? Click on Bybit Learn. And what we have just spoken about, right? About the beta testing, then blog and then Crypto Insights. And then we have an article also about the battle tested nature of these exchanges and how folks like Bybit have weathered that historic event on October 10th. And that is right about here, right? Postmortem from last Friday's liquidation, right? So there you can, again, get more information about how these different major players across the crypto ecosystem has really weathered such an event, right? Now, we've also got another great question, about how Bybit's push into Web3, right, through alpha and such, and again, this goes back to what we mentioned at the start of this conversation about how, for the purposes of this conversation, right, we started with some nice, tidy, Excel boxes, right, that put things in its own little, 2D boxes. But in reality, you're right. Those lines are being blurred, right? Because there's so much growth potential across the space. To be clear, I'm not positioning this as a us versus them kind of thing, right? I think overall there is a maturing of the entire space, and ultimately it's providing the better option or best options or more options for folks like you, right? So yeah, yes, you're right. There is this blurring of the lines between so-called, pure play centralized versus DEXs, right? But I think the question also goes one step further. And Andrew, let's see if you can take on this as well. I think there's a question about the liquidity, right? Because one of the criticisms about the DEX side is that they clearly don't have as much liquidity as centralized exchanges, right? Although having said that, shout out and credit where credit is due. I think Hyperliquid did a great job in actually solving that front, right? It's got not just its own layer one blockchain, it's got its own exchange, and it's got enough liquidity, and that is that they've used, it goes back to the flywheel that we mentioned earlier as well, but then also their order book matching orders mechanism as well, right? So I think Hyperliquid really stands out there, right? But maybe you can talk to us about this, when it comes to the liquidity, right? Especially in the DEX space, right? Can there be some synergies between the centralized and the decentralized space? I mean, if I'm reading this question correctly, it sounds like centralized exchanges becomes the market makers or the LPs or the decentralized space. I mean, is that a fair interpretation of your question? I'm not sure. Yeah, Andrew, what's your take?
Yeah, anyone who has ever tried to enter a position, exit position in a timely manner knows how important liquidity is, right? And liquidity in crypto at the moment is still incredibly fractured, I think. We see this from a data point of view, where if we want to get a good picture of the market, there's not always, depending on the token and the asset class, of course, it's not always a single place to go to see a full picture. People are trading this thing, the price is being discovered in multiple different venues. To add to that, those different venues are implemented very differently. Price discovery is impacted by those sort of idiosyncratic inefficiencies on every exchange, right? So to my point earlier, where institutions expect quite a lot of liquidity, these guys are trading in quite a lot of size. They may not like the idea of putting that across lots of different exchanges, or they may like it actually for increased, diversification of their counterparty. But as you said, with decentralized exchanges, I think so far, up until, let's say, the launch of these new generation of exchanges, that liquidity has been hampered by the implementation on chain, right? Order books are really the way that I think market makers like to work. It's the way that they do this kind of stuff in traditional finance. It's the way that they show quotes, even OTC. You submit an order, you have a bid or an ask. But perhaps that's what's needed to follow on from the great ground that's been built by some of the automated market makers. I think in reality, what we'll see is a continuation of both venues. I think we will see hybrid exchanges really start to win out. I think we will see people who are able to consolidate liquidity from as many different places as possible really start to win out, because liquidity gives you a better user experience.
I know it's 40 past already, so I tell you what, let's end with this. Perhaps this guy came from a viewer who missed the first section here. And super producer Galvin, let's go back to slide number, I want to say slide number 5, right here. Right. So again, the question is about the differences between a DEX versus a centralized exchange, right? So again, for beginners, I think it's important to impress, right? Again, we are operating in a spectrum here. The answer really depends on you, right? Whether, to put it in a perhaps oversimplified context, right? If something goes wrong, do you need that hand-holding, like somebody to call, or more importantly, somebody to be accountable for it, a person, right? And I think this goes down to a lot of the transactions or the transactional nature of society as well, isn't it, right? Whereby, if something goes wrong, I got to find somebody to blame, right? So whether you're on that side of the spectrum or you are okay with the risks or offering your entire trust to tech, to smart contracts, right? And making sure that they have got your back as well. In TradFi, I'm sure, Andrew, you're aware there is this term called fiduciary duty. Now, to be clear, of course, that is not the same as what we're talking about here. But the principle applies, right? Whether somebody has got your back. So it really depends on how you answer that question. I think that will determine your propensity for either DEXs or the centralized space, right? But again, as Andrew highlighted and spoken through this slide earlier, this ranges from everything from your trust to the KYC requirements, privacy, transparency, and each of these have their own respective trade-offs, right? That's the word you used earlier, Andrew. So yeah, I think it's important that we're all aware of this. I think ultimately, I hope, it is my sincere hope that from this live stream, you will walk away with just more insights and more familiarity and understanding about, this ever-growing, ever-maturing space that we are in, that it's able to weather historically volatile events to even the business models, right? And how it's going to be evolving. And look, I think it's going to be a really exciting time ahead, and we don't have to wait that long, right? Things are already happening, not just this year, but we would certainly expect them to continue evolving for the years ahead, right? Andrew, do you share that optimism like I do, or am I just perhaps being my own cheerleader here?
I'm incredibly optimistic. Bullish crypto, yeah. That's why I'm in this space. What we're seeing is people really increase the user experience. They're able to do that now after, crypto's been around how long? Several years. We're fine-tuning, I think, getting closer to something that people want to use, finding use cases, making it useful for institutions as well.
Yeah. All right. So on that note, right, again, thank you so much for your time and your insights, and thank you for joining us. And one final reminder of the giveaway here. If you haven't done so already, do scan the QR code for your chance at your share of 4,000 USDT. And of course, by all means, feel free to check out all of our resources that we have on bybit.com, and specifically the Bybit Learn section. So I think with that, any final thoughts or comments that you'd like to share with our lovely audience here today, Andrew?
Just go and read our research. And thank you very much for having us.
And happy Halloween. Yeah, big thing for you.
Happy Halloween indeed.
Yeah, sure. Or at least, if nothing else, happy Friday. Thank you guys so much again for watching, and till next time, I'm Han. See ya.